The economy rests on unstable ground, the foundation's weakening, and the consequences, they're dire. We're going to show you a number of economic reports released just recently that just kind of got lost in the shuffle. But the message we can take away from this, it's really not that good, to say the least. Starting out with the housing market, it's rising, but it's slowing. This is the Case-Shiller Home Price Index released last week. Now, the inflationary cycle certainly has been kind to housing market prices. They have risen. However, on a year-over-year basis, not the same picture. We can see here Case-Shiller Home Price Index, the current month rising only at a rate of 3.6%. It's the slowest increase we've seen in over a year, certainly down from the 6.6% highs achieved earlier at the beginning of 24. Now, durable goods, they're at 5-month lows. Durable goods are those goods produced, meant to last 3 to 5 or even more years, like appliances, those go in homes. So it's pretty highly correlated to the housing market. Here's durable goods on a year-over-year basis, falling to a rate of negative 5.2% compared to this time last year. That's the lowest low we've seen in about 5 months. Certainly not the only negative number we've seen in the past year either. And this certainly does not speak very well in terms of the housing market. In terms of the new orders from manufacturers, well, they're sending us mixed signals. We can see over here manufacturer new orders on a year-over-year basis. Well, the capital goods, that's down 15%. Transportation, down 16%. That's really the worst part about the manufacturer's new orders report. To the upside, computers, that's up 9.5% and 11.5% for defense issues. Now, we take a look at the manufacturer's new orders. This really does illustrate the divergence. We can see here there's defense in light blue, computers in a dark blue, and pretty much rising across the board for the past year or so. But conversely, you take a look at transportation in red and capital goods in green. Capital goods are things like machinery and other equipment that are used in businesses, especially new businesses for that matter. And those are basically in the negative for quite a long time. And most recently, the worst negative number we've seen in about 6 months or so. Construction spending, it's heading lower. Total construction spending on a year-over-year basis, it's up only 3%. That's the lowest low we've seen in a long time and a lot lower than where we were about a year ago, almost at 10% year-over-year returns. That is not good. This is construction spending, and it's very closely linked to a lot of areas of the economy. Here's construction spending on a year-over-year basis, the different categories. In particular, note the weakest part of the construction spending are commercial, like strip malls, things like that, and also lodging, which directly reflects consumer spending and their appetite for, luxury goods, disposable income, that sort of thing. That's not good. It means that the shopping malls really aren't coming back, and new construction for lodging projects, that's not coming back either. In red, we see the manufacturer's new orders for motor vehicles, and in blue, the construction spending for transportation. Now, I thought it was interesting to show this report because these are two different reports. Again, the red is the manufacturer's new orders, the blue is construction spending. The link between the two, they're both tied to transportation. And they have a pretty close correlation. When one declines, so does the other. And conversely, when one rises, so does the other. So we're seeing different reports, reported with different metrics. But when we talk about a similar industry such as transportation, we can see the trends, they're there. This week we have a lot. Factory orders on Monday, Tuesday, the job openings. We have the JOLTS number Wednesday, the ADP number, wholesale inventories on Thursday, and of course the big jobs numbers on Friday. And certainly watch those. And I think the thing that we should watch more than anything are the 10-year bond yields. They've been very strong. It'll be very interesting to see after the market's able to digest all of this economic data, especially centered around employment, what the 10-year bond does. And we're going to talk about this. Its reaction that reflects the state of the economy. We hope this has been helpful. We look forward to seeing you back soon.